Thank you, Peter. Look, today what I'll talk about is effectively, there's a quick general advice disclaimer, of course, which takes days to prepare and a few seconds to show on screen, but just a reminder that everything I say today is of a general nature only. Look, what I thought I'd talk through today is broadly, I'll spend most of the presentation talking about the backdrop because I think it has important implications for investing generally. And also income investing in particular. Given the strength of the recovery, the outlook for inflation and interest rates, I think that kind of really defines everything. So first of all, the business recovery, as we've always maintained, we thought there would be a strong recovery, a V-shaped recovery the first time around. Yes, that was disrupted by the lockdown, but of course we can see now we've again resumed the V-shape, and you can see there in the chart. Business confidence is kind of the highest it's been in more than a decade. So remember, it's a business cycle that drives the economy. So if business is confident, if business is willing to invest, they'll drive the jobs and the opportunities and the business cycle that ultimately results. So we're touching new records. Consumer confidence is now bouncing back very strongly as well, which is good. Employment gains are very solid. Fiscal and monetary policy was enormous. It's pretty much been withdrawn. Remember, Australia was ahead of the curve in the recovery. Did get disrupted with the lockdown, but of course we're bouncing back quite quickly. And as Commonwealth Bank recently noted, Australians have about $230 billion in excess savings, which is sort of driving the recovery as well. So there's always a bit of a chance that we could bounce on the upside here. And finally, the global economy is sort of poised for a bit of a post-war boom. You know, COVID's been a bit like a war. With a war, of course, the troops are overseas. They come back home. Everyone wants to get over the bad times and consume and get on with their lives. And I think COVID has a similar sort of phenomenon. The two things result, though, as I've been talking about all year, is good solid growth, which is what we're seeing, but also inflation again, which is what we're seeing both in the United States and also here in Australia. I just thought I'd put these in here as well because they came out last week from the Reserve Bank, just some forecasts, and clearly the Reserve Bank sees pretty robust growth sort of heading towards 4 or 5% in 2022, fading back to normality after that. And also CPI inflation, they do see that pretty much under control. I must say there is a bit of a conflict between what we're getting. The central bankers in Australia, the US, elsewhere are all very confident that inflation will stay low. On the ground, talking to businesses, talking to CEOs, the feedback we're getting there is that they think inflation is actually on the rise. To give you one simple example, suppliers to supermarkets are telling us that normally there's one or two things that are inflating and that they can usually manage that process pretty well. At the moment, though, they're getting double-digit increases in all inputs, or 90% of inputs that they're supplying supermarkets. So it's hard to contain that inflation, and it probably will be passed on to the consumer. We think all of this stuff is yet to fully sort of work its way through the system. We're a few months behind the United States. The United States has got this first, and then I think it'll sort of ripple across the waters. Also, the unemployment rate, as you can see there on the right-hand side, the central case is that we're heading towards very low levels of unemployment in the next year or two. But note that there's one scenario, the upside scenario, where we could see by the end of 2022 an unemployment rate of sort of 3.5%, which is sort of unheard of since the 60s. So these incredibly low rates of unemployment, a really tight labour market that bodes pretty well for wages, growth, consumer confidence, all those things. But again, a little bit of inflation concern there as well. Just more evidence of the V-shaped recovery. Normally we take 4 or 5 years to recover from these sort of recessions. With the COVID recession, it's been extremely V-shaped. We've bounced back extremely quickly. And I think that's what's caught people off guard. And normally the central banks have years to prepare for higher interest rates. I think instead that these sort of things will come on sooner than expected. And again, that will impact everything we do when we're trying to generate income for our clients. And lastly, I think there's two things to look at. There's growth is actually being revised back upwards. So in the US, the Atlanta Fed has suggested that growth could be about 8.6% this quarter. But we've always thought that employment was the key thing to keep our eyes on. And at the moment, you can see there the National Federation of Independent Business hiring plans, and that chart is inverted. So it's upside down so that you can see the correlation with the unemployment rate in light blue. But what that's telling us is that the US could be heading towards incredibly low rates of unemployment. We saw a hint of that this week when the jobless claims in the US fell to 199,000. last week, which is the lowest since November 1969. So again, it's consistent with everything we've talked about. The recovery is more V-shaped, it's stronger, it's sharper, but it also means more inflation potential, risk of the wages blowout, all those sort of things. And again, this all has implications for the way that we're looking at the world in terms of investing. And lastly, the stimulus, again, another huge stimulus package in the US in the process of being passed. That'll take the total US stimulus to something like $7 or $8 trillion, or 40% of GDP. Some of it's now, some of it's spread over the next 10 years, but it's still extremely high. And it's the sort of stimulus, the only other time we've seen stimulus this high, which has pushed the output gap to well above sort of excess levels. And that is, the last time this happened is really the Great Society package of the 1960s under Lyndon Johnson. And you can see there what happened is that the output gap, this is the sort of froth over the edge of the beer glass chart. So the economy can grow below potential when it's below the black line, or it can grow above potential. The output gap is higher, is in excess territory. And at the moment, there is a risk under a high growth scenario that people spend their money very quickly, that you do get all this stimulus work its way into the economy too rapidly, and it creates this sort of froth and excess demand and potential for inflation. And the mid-1960s, those packages kind of preceded a higher level of inflation in the late 1960s before the oil price hikes even occurred. And again, that's the fear now, is that too much stimulus in the US has pushed inflation too high, and that we're seeing that already working its way through the system. To give you also a sense of maybe the upside scenario, the high growth scenario kicking in, retail sales just also came out and suggested that in Australia, and we expected sort of 2.2% or 2.5%, but it was up in the sort of fours. So it suggests again that the consumers want to get out there and spend, but that also has upside risk for inflation and interest rates and so forth. So a little bit of inflation for longer. I just thought I'd mention this again before we get to our investment conclusions. Look, a lot of it is transitory. I think people have been caught into, you must be in the transitory inflation camp or the longer term inflation camp. There's actually a bit of both. There's some transitory inflation. Clearly, used car sales aren't going to stay high forever. Eventually, the market will kick in. Supply chains on that stuff will be fixed. But we are also focused on these longer term inflation issues, things like the fiscal regime used in the past 2 years has worked so well. People's QE, literally printing money and giving it to people rather than the banking system, which is sort of technical QE, which we use since the post GFC period, has worked so well, too well, that maybe people are addicted to it, and maybe that regime is going to be used for a lot longer. Whenever there's a near future downturn, the instead of turning to the central bank first, government will simply hand out money to people and get the central bank maybe to finance it, because it's been so much more effective in getting the economy out of recession. But it does raise a risk that politicians will reach for that lever more frequently in the future of people's QE. We're already in that world. People talk about modern monetary theory and people's QE as some sort of future crisis solution. It's sort of here and now. Secondly, house price rises do lead to higher inflation and rent, especially in the US, and we're yet to see that kick in. So house prices have risen the highest on record, even higher than before the global financial crisis, and that is gradually working its way into the CPI basket. Rent is 40% of the CPI basket, so that will actually kick in the first quarters of next year. The trade war, even though we might get some resolution to some of these short-term supply issues, remember the trade war is not going away. China realises the trade war is not going away. They thought it would help under Biden, but they've more or less given up. And so everyone is turning a bit more domestically to grow industries, to make sure they've got their own onshore manufacturing in case of future crises and things like that. Demographics, cost of ageing and healthcare, and those sort of things also are inflationary. So there's a general rule, wherever the baby boomers go, you can pretty much put your money on that, because they're one of the biggest population cohorts, and they've more or less defined the ups and downs of the economy, consumer demands and markets over time. And at the moment, the midpoint baby boomers were born between 1946 and 1965. The midpoint of that is almost exactly 65 years of age. So I think COVID is sort of seeing a few people pull forward retirement, but it's a big cohort that'll start drawing on their savings rather than contribute to the savings system as they have done for the past 30, 40 years. Decarbonisation, I think it's a trend that must happen, but also it is inflationary, potentially. To give you one hint of this, if we apply, the new European sort of carbon border adjustment to cement, for example, it would increase the price of cement about 65%, is one potential measure. So we will see prices come up as a result of that as well over time to appropriately decarbonise the economy, but there is a price to be paid for that. And lastly, and probably most importantly, wage pressure and inflation expectations. So what got the inflation in the 1960s and 70s going, and we're a long way from that yet, but basically it was when labour markets were really tight and inflation was going up and people expected more inflation, they started putting in more wage claims. And the wage claims and the resulting inflation kind of fed each other. Whether it was demand pull inflation or cost push inflation, 50 years on, economists still can't agree on that question, but clearly they are connected. They're quite symbiotic. And so we don't want to have, as we're already seeing in surveys, consumers expect more and more inflation, they start factoring it in and they start demanding that in wages and so forth. And in a tight labour market, of course, the bargaining power is all very much in their favour. The conundrum for markets is look at where interest rates are and look at where the economy is. So the global manufacturing PMI, and that's just a short code for sort of economic strength, it's the Purchasing Managers Index. It's what businesses are actually doing in terms of ordering new equipment and things like that. The PMIs globally are very strong, and you can see there that interest rates should be somewhat in alignment with where the PMIs are. Now, since COVID struck, there's been a disconnect. So normally we should be seeing at the moment, we should be seeing interest rates of more like 3 or 4, or, for 3.5 to 4.5%. The 10-year bond yield is nowhere near that, though. The 10-year bond yield is still stuck in this sort of 1.6, 1.7% range. Why is that? You can see the man in the middle of those two, that gap there is Jerome Powell. So Jerome Powell at the Fed has been spending like crazy on the 10-year bond yield to suppress that yield down to very low levels. And he can only maintain that for so long. At some point, he's got to make a judgment between do I keep the 10-year bond yield artificially low instead of letting it rise to 3 or 4 or 5% where it should be, or do I just let it go and allow the interest rate to find its natural place in the economy? If inflation pressures keep building up, there's a view in markets, obviously, that they will let that bond yield go and they'll start to raise rates. At some point, the Fed has got to bite the bullet and realise that that process has to begin. Now, Jerome Powell's not confirmed until February, but of course, we did see in the last few days Joe Biden say that he will be reconfirmed for another term. And at some point, I think it'll be incumbent on Powell to say, you know what, we saved the economy yet again during COVID, but in fact, now we've got inflation problems and we've got to start tightening policy. And that'll be the real test of markets at that point, is that if bond yields drift up, clearly a lot of assets will be repriced downwards. And we've got to be invested in those income-producing assets that can survive that process. What it means for us, look, we have 4 listed products that are available in the market for investors to choose from. The 2 in the middle there that are ETMFs, or Exchange Traded Managed Funds, are the GIVE, the GIVE, the Perpetual Equity Ethical SRI Fund, which is invested into undervalued securities, but also goes through an ethical SRI filter. A portion of the performance fee of that fund is also given to charity, hence the ticker code of GIVE. But it generally invests into a number of assets, and it provides an income. It'll distribute income every year, and a dividend yield approximately in line with about 4.5% or thereabouts, in line with where the market is at. The other ETMF there is the ASX Idea, which is a global innovation fund. The income from that fund will be lower, but it does also provide long-term capital growth as well. And it does beg the question with investors, sometimes you're always better off investing in a high yield fund or investing in one which generates a better total return and generating your own income, so to speak, through redeeming units. That's certainly something that investors can do. They can do both really at the end of the day. So there's certainly options that investors might want to consider. But it's the 2 vehicles on the left and the right I want people to focus on the most. So in Australian equities, we do have an LIC, or listed investment company, called the PIC, the Perpetual Equity Investment Company. The ASX ticker is PIC. This one does deliver high levels of franked income, so it'll look to deliver, grossed up yield of sort of in the 5 to 7% range. It doesn't distribute capital gains, so to speak. We will always try and deliver a fully franked income stream. And the unit price, the NTA of the company will continue to rise over time as well. So that's the main aim. It's a high conviction portfolio, a select group of Australian equities and up to 35% global equities. And on the right-hand side, you've got also a listed investment trust, which is also an income-focused vehicle called the Perpetual Credit Income Trust. And that looks to deliver the RBA cash rate plus 3.25%. So of all these listed vehicles, I think on the left-hand side, the PIC is the best way to get income from the equity market that we have to offer. On the right-hand side, the PCI is the best way to get income from the fixed income market. And that is one of the last places left you can get a decent income in corporate bonds in Australia, which I'll talk about in a few seconds in conclusion here. So you can see here, first of all, I'd say from our perspective, being underweight duration makes sense. If Jerome Powell has to let the bond market go and let those yields drift higher, that will be very bad for fixed income assets, sovereign fixed income assets that have a fixed coupon payment in a world of rising inflation interest rates. Corporate bond yields, which is what the PCI is invested into, as I said, this is one of the last, as Fairfax, the Sydney Morning Herald wrote an article on this, Clancy Yates, a few weeks ago. The corporate bond yields are one of the last glaring anomalies. You can't get money from cash in the bank. You can't get money from sovereign bonds, but these corporate bond yields pay that sort of 3% plus yield. I think that's a very good place to be, and it is an anomaly left, which I think people need to consider. The article was saying it's actually hard to access those sort of assets. Well, you can access them through the PCI. That's exactly what it was set up for. Domestic equities, as I said, we still think of the opening up normalisation traders there. Insurance companies are still undervalued. A lot of industrial stocks are still undervalued. PIC will also invest into a lot of metals and miners as well, which we think have still got strong support behind them. And lastly, global innovation, less for income, more capital growth story. But as I said, you can also manufacture your own income by trading those securities potentially as well. So thank you very, very much for your time. And I hope that's been a benefit in terms of our outlook for the markets and what to invest into for income.